Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Nam Phan of Pacific Private Money and Rob Spinoza of Guaranteed Rate. Mark Hunt is off today. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon, with 2 locations in San Francisco and 1 in Marin. And today's trivia theme is, yet again, random trivia. I gotta keep you guys on your toes there. Noam, why don't you go ahead and start us off?
Yeah, I'll start with reading a couple of headlines on real estate, and specifically San Francisco real estate. 2 articles that came out this week. First one is pent-up supply floods San Francisco housing market, most since housing bubble, or since housing bust. Second article headline is San Francisco is preparing for an exodus of homes for sale, reaching near recession levels. So going into the first article, supply of homes for sale has more, has more than doubled. Homes are being pulled off the market again, pending sales lack pent-up demand. Buyers now have the largest choice of homes for sale since the housing bust nearly a decade ago. There is a lot of discussion about the low levels of inventory for sale as potential sellers have pulled their homes off the market or not wanting to list their homes at the moment, waiting for the pandemic to blow over, or waiting for more certainty or whatever, or their mortgage is now in forbearance and they don't want to make a move. So these articles are interesting because one is talking about sellers pulling their homes off the market, and the other one's talking about the record number of homes that are being added to active available listings.
Yeah.
And
wow. So,
if you look, yeah, a little bit of a opposite, but the number of active listings, though this article cites, surged to 1,344 homes in the weekend of July 5th. And
so now where I was going with that is not only do you have the active listings increasing, but you also have people taking homes out of the listing, so it would otherwise even be even higher.
Right.
If both of those hold true, right?
Yep. Yeah, you're right. So they can hold true. And the interesting thing is, sellers pulling their homes off the market. This second article that I mentioned, it shows, some of the reasons why maybe people are pulling their homes off is they're not going to get the price that they think they're going to get, because they're seeing rental rates drop. They're seeing homes maybe staying on the market a little bit longer. And this is San Francisco specifically. So I'm not sure if you're seeing that same sort of stat in the outlying areas, because what we've seen sort of anecdotally over the last several weeks, or maybe the last month and a half, is the number of people moving into the burbs out of San Francisco. So I don't know if this is isolated to the city of San Francisco itself.
Well, it's all COVID, it's all COVID related, right? The shelter in place, people are kind of going, hey, I can work from home. Why be in an expensive area? I've got a little bit too small a space, that sort of thing.
Yeah. Or the fact that, you know what, this is the first month, or maybe, mid-June to now, all of this pent-up demand, people are suddenly rushing to list their homes when, for March, April, and May, people held back. So there's a flood of homes that otherwise would have hit the market over a 3-month period, pre-COVID. Now all of a sudden hitting the market all at once. So it's flooding the market with new listings where people are saying, you know what, I'm going to hold, maybe I'll pull back, or maybe the realtors are telling them to pull back, saying, you know what, there's too many homes right now. They take it off and put it back on in the fall, because typically in the fall you have that second spring season, what they call it, of homes being listed. So I think it's an interesting stat, but I guess it'll play out more as we go through the end of July and into August, because the other part of it too is people won't be schools won't be opening, it sounds like, and having students going back to school. So are people just going to, instead of waiting for school to start, they just start listing their homes throughout August? Because a lot of times people wait until school starts up again before. So I don't know if you're seeing,
You know,
how are you seeing things on the mortgage side as it relates to this? Rob, are you seeing
Yeah, I mean,
lending?
we've seen a definite, yeah, we're seeing, a lot of activity. I'm based in Marin, so we're seeing a lot of activity in Marin, people moving into Marin, and we're seeing high demand for desirable property. So in that sense, I haven't perceived the shift that now I think is evident in the city.
Mm-hmm.
But I would also, this drives home another point that we see in real estate all the time. And as a radio show here, talking to people about real estate, I don't think we can gloss over the fact that there's always, always, always a herd mentality with these sorts of things. So, buyers and sellers alike get complacent. I'm not faulting them, but they get complacent with the trend in place, never really understanding what would happen if the trend shifted and how quickly and fully it could transition. And we're seeing that now. Obviously, this was prompted by something nobody expected to happen. But nevertheless, you had people who were probably ready and able to list a home in a market and chose not to, anticipating things would be normal. And now they're not. And now you've got all of these other people piling on that trend as well. It sounds that way anyway, at least in the city.
Mm-hmm.
And it will be interesting to see how, because there's a lot of really good real estate agents in the city. It will be interesting to see how they position their clients, what they counsel, and how this thing smooths out or doesn't over the next 2 or 3 months. Because remember, everybody was expecting shelters in place and life to go back to normal. That doesn't look like it's going to happen. So, yeah, it's going to be interesting to see the next couple months.
All right. If you guys are ready, we are going to go to our first trivia question. And here it is. What Australian rock band released the album Business as Usual in 1981? All right. The first caller with the correct answer is going to win that tanning certificate. 888-912-1190. Don't touch that dial. The best of investing. We're going to be right back. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Nam Fawn of Pacific Private Money and Rob Spinoza of Guaranteed Rate. Our first trivia question was Business as Usual. What Australian rock band released that album in 1981?
Rob, you know that one?
Men at Work.
Men at Work. That is correct. All right. Noam, you have another tidbit about San Francisco real estate.
Yeah, so I'll continue on with the one of the articles that I started the segment with is one other stat is 30% of the homes on the SF market are listed at under $1 million, over twice as many sub 1 million listings than this time last year. Based on standard seasonal patterns overall, real estate listings should be declining. But, again, could it be just that all of these people whose homes are under $1 million, instead of listing it in March, April, or May, listed it all at once in late June, July? Or is it just that the starter homeowners all decided, hey, I want to move out of the city and into the burbs? So, or maybe it's both. Maybe it's a combination of both. But, that's another interesting little tidbit there that, hey, if you're looking to move into San Francisco, now's a great time to buy into the city and get a, relatively affordable home compared to other markets or compared to what has been in the past.
Let me ask you guys, because I'm not from San Francisco Bay Area. I moved up here in the early 2000s. But do you recall a time where San Francisco was considered undesirable and properties were relatively inexpensive, or has it been, like Marin?
Well, I remember South of Market was undesirable in the 70s.
Yeah.
It wasn't until the 80s that the trendiness came. I mean, you have Seacoast, which has always been a good area. Tenderloin's always been a bad area.
I would say, on just a general basis, I think San Francisco has been desirable. But as Edward said, it's probably, a street to street, there's certain areas that are less desirable than others. But I think in general, San Francisco has been a destination for a lot of people. Yeah. But it is really interesting. I wonder if other densely populated metro areas are seeing the same kind of pattern.
I think they are. This whole shelter in place, that's the next point I was going to get to, is this whole shelter in place where people are not realizing their space is too small. as well as, hey, I can work from home. Why don't I go to a cheaper area? Interestingly enough, San Francisco has been having a lot of growth with Salesforce Tower, and there's been a lot of boom in the building. But what I thought was interesting is I was talking to someone who was very high up in a fairly large company recently, and we were talking about the fact that a lot of people working from home and all that, and I said, my crystal ball, be it right or wrong or indifferent, I said, I believe people think that they can be productive working from home. And maybe the first couple of days, they might even wear a suit and tie when they go to their computer, in their little home office, right? But after a while, they show up an hour later, they leave an hour earlier, they come in their pajamas, the interruptions with the dog, the kids, the wife, whatever. And suddenly they're going to realize, or the companies are going to realize, they're not quite as effective. So he said that they're actually starting to see that now with the standpoint of some of these companies that were only 25% of the employees were supposed to come back to work. And that was in the beginning of the COVID. And now it's a situation where they're requiring 50%. Now they're staggering it with the number of hours so that they don't have too many people right next to each other, social distancing. But they're already noticing the fact of, hey, you know what, this shelter in place working from home is not all what it's cracked up to be from a productivity standpoint. So I think what will end up happening, excuse me, just to finish that thought. So I think what will end up happening is companies will realize, we need to have you back in the office, and you're going to start to see a resurgence back to the cities.
So
yeah, I mean, I think there's a lot of truth to that, and I also think that one of the things that happens with events like this is people go through the equivalent of like the 7 stages of grief, right? So you've lost a loved one and you're in denial for a bit, and then you realize that you have to make adjustments in your life, and you make those adjustments. Well, when everybody first got forced to work from home, they did the best they could, right? And that best they could was better than nothing, which was the alternative of being forced out of work by a pandemic. But now, that's not the standard anymore. The standard is now the business needs to get back to a certain level of operation, and what cut it initially to address, plugging the hole because now everything has stopped. Now that's got to migrate into what it needs to be. And for some, that's going to be a painful transition, because you hit the nail on the head, Edward. Some people are going to be now like, hey, I'm comfortable. I don't like getting up at 6 a.m. That thing that used to force me out of the house every morning because I had a commute, I don't have that anymore. Now I just start showing up later and later every day. Nobody knows, that is going to impact across the country. You're right. That's going to impact.
Yeah.
Edward, you've been very productive working from home. I mean, how many Sudoku puzzles have you been completing every day?
Well, you should see me on Hearts against the computer. I'm the bomb, man. I'm the bomb.
All right. Yeah, but that's interesting. So if all these people who are selling now, and employers eventually are saying, over time, hey guys, we need more people to come into the office. Yeah. All of a sudden, there's going to be a migration back to the city, and people will be snapping up properties again.
See, that's the thing is, it's like it's kind of all real estate, because it's just lots of transactions, lots of people buying, lots of people selling, and
what I was going to say. Right, exactly. And one of the other things about that is that some of those people who may be leaving are renters. And you are seeing that in the city now, because there's, from what I understand and read, high degree of vacancies in rentals, and landlords are not able to get what they thought they were going to get on their rent for the properties that are becoming vacant. So I think when you're leaving the area and you're moving away and selling your house, you've probably got a fairly strong commitment from your employer that that's going to fly for at least the foreseeable future. But if you're not getting that commitment and you're a renter, that, you know what I mean? Then what have you got to lose? Your risk in that. Look, if I get driven back to the city, I'll deal with it when and if that happens.
Yeah. You know what? It'll be interesting to see, of those sub-$1 million homes, how many of those were investor properties that they're selling because the tenant moved out. And these are landlords saying, you know what, I'm not getting the rents I'm getting, so I'm going to put this home on the market and sell it.
Gotcha.
That could be it too.
All right, guys, we're going to cut to our next commercial break. When we come back, we're going to have a little email time and deal of the week. I want to make a quick mention here for the Mount View Hotel and Spa in Calistoga. So enjoy their luxurious pool, hot spring, mineral water, jacuzzi, as they provide proper social distancing in the large pool area. Enjoy the magical themed dinners in the in our new private hotel guest outdoor dining. Centrally located in Calistoga and within walking distance of many amenities, including wineries. Check them out at www.mountviewhotel.com for reservations. Second trivia question is, who succeeded Stalin as Communist Party leader? Which Russian was that? All right, call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. That's our trivia question. Who succeeded Stalin as Communist Party leader? All right, don't touch that dial. The Best of Investing is right back. Welcome back to the Best of Investing. Edward Brown here along with Rob Spinoza and Tom Fon. Mark Hoffman is off today. Second trivia question was, who succeeded Stalin as Communist Party leader? Who took his place?
Nikita Khrushchev?
Yeah, Nikita Khrushchev, that's right. Yeah, Lenin was way back in before Stalin. But very good. Very good, Rob. Okay, so
you know what?
Khrushchev and Men at Work, I'm on a roll.
You cut in and out there again, my friend. What'd you say?
Nah, sorry. I said Nikita Khrushchev and Men at Work, I'm on a roll.
Yeah, that's right. Yeah.
Yeah.
And no, what were you saying, no?
Oh, I was saying that Rob looked online when he was
pretending to cheater. Yeah. Okay, so
no, you're just the man.
Dom, we have an email that comes in from a listener. It says, please explain how investors in your fund can make more than the distributed rate of 7.5%, because that's apparently what you guys are paying now. If Pacific Private Money chooses to foreclose.
Yeah, so good question. Essentially, the question is, how can an investor make more than what we've been paying, which is generally around 7.5% to 8% on a monthly basis distributed to investors? And the question pertains to the Pacific Private Money Fund, which is our primary fund, currently at about 57 million or so in assets under management. When a borrower falls behind and it gets to the point where we have to file a notice of default and take the property back, foreclose on it, and sell the property, there's the opportunity where you can actually make a profit on that sale above and beyond, the loan amount, and the profits are distributed to the investors if there is a profit. So, typically in our fund, the weighted average loan to value is 60%, and that loan to value percentage is critical in determining whether or not you can make a profit when you sell the property. If you're making loans at 90% loan to value and you have to take the property back, and what do you have to do before you sell it? You have to do a little bit of maintenance, updating. There's fees to list the property. There's commissions to realtors. When the property is sold, that eats into that 10% equity to the point where you can actually have a loss. But with the Pacific Private Money Fund, being that it's fairly conservative with respect to loan to value, you have 40% equity in that property on average for the loans in the fund. So if you have to take a property back and you have the expense of rehabbing it, updating it, paying commissions, that does cost something, and it eats into some of that equity protection you have. But at the end of the day, at least with respect to the loans and the properties we've had to foreclose on, there's been enough when we sell the property to actually have a profit, and we distribute it in the month that money is realized, that profit is realized.
Yeah, because to date you have not had a loss on any properties that you've had to foreclose on.
Exactly, whether it's been in the Pacific Private Money Fund or outside of the fund. But the properties that we have taken back, we've sold, as you mentioned, no loss, at a profit. It's distributed in that month And, investors have seen returns. I think the most recent one was resulted in an 8.25% annualized return for that month.
Very good.
So we don't want to be in the business of foreclosing, obviously. We're not loan-to-own lenders, as Mark has mentioned before. Typically we're going to try and work it out with the borrower. We want to give them the opportunity, but in the worst-case scenario where we take the property back and sell it, it's been a profit for that month.
At some point, we'll get into a deal of the week so people can understand the kind of loans that you fund. But for now, how do people get a hold of you?
Yeah, they can give us a call, 415-883-2150, or they can go online and go to www.pacificprivatemoney.com. And best always give us a call. We love talking to people, and there's always questions that people have that we can answer right away to see if this is something that they want to invest in or not. And I'll quickly go through the criteria for investing. Number one, you have to be accredited. So investors in our fund need to show that they have $1 million net worth, exclusive of their primary residence, or they can qualify on income. As an individual, if you can show $200,000 a year in income on your tax returns, that can qualify you, or $300,000 as a couple. Minimum investment is $50,000, and there's a 1-year hold. Okay. So we ask that investors stay in for a minimum of a year.
And no fee to get in, no fee to get out.
Exactly.
So let's move on to Rob. Rob, how much lower can rates go? I understand that they dropped yet again. This is from a listener who's been watching the interest rate market.
Yeah, can you guys hear me okay?
Yes, we can.
Great. Okay, so this is the conversation we're having every day with every client is, do you think things are going to go lower? And the answer is, I don't know. I don't, I'm not a market forecaster. I'm not an economist. And certainly we're in unprecedented times, for a lot of different reasons. And what I counsel people is, look, when you're sitting on historic lows, which we are right now, and what I mean by that is we're sitting on historic lows consistently. So it's not just like one day and then they're gone and, a volatile stock market day or bond market day, but we've been on 30-year fixed rate loans, in many cases under 3% with some consistency. So, to counsel people to hold out for better when you're sitting at historic lows, to me, doesn't sound like a prudent piece of financial advice. So I would say to anybody who's out there right now, if you can financially benefit either by buying or refinancing, and you're looking at today's rates, you've got history on your side. It's never been lower than this for fixed rate money. Certainly not, in any recent times. And what are you holding out for? Are you holding out for a quarter better, a half better? I don't know what circumstances it would take to get us there, but I know that whatever circumstances it does is going to bring about other, side effects or ramifications or implications, because to get to 2.25% on a 30-year fixed rate loan, it means that something is very different in the economy. And I don't know what that is, but I know that when we get to that point, everybody will have other considerations. Will they have a job? Will their house be worth what they think it's worth? I don't know. So look at things we have right now, take that into consideration, and act carefully on it.
And how do people get a hold of you if they have more questions about interest rates or refinancing their house?
Yeah, I work for Guaranteed Rate, one of the largest independent mortgage banks in the country. I'm based in Marin County. My phone number is 415-367-5959. Believe it or not, people called me off of the radio show, and somehow they remember that number, and I didn't repeat it. 415-367-5959. 415-367-5959. So and you can find me online on Yelp, on LinkedIn, on all those sources. Rob Spinoza with Guaranteed Rate, and happy to be of service.
Very good. Thank you, sir. Okay, third trivia question. Which cuisine gave us kimchi and bulgogi? All right. 888-912-1190. First caller gets the correct answer, gets that tanning certificate, which is worth over $100. Stay with us. The Best of Investing will be right back. Nom's going to give us a deal of the week. Welcome back to the Best of Investing one more time. I'm Edward Brown, your host, along with Mark's gone. I'm so used to saying that. Nom Phan of Pacific Private Money and Rob Spinoza of Guaranteed Rate. Third trivia question. Which cuisine gave us kimchi and bulgogi? Yes.
Go for it, Rob. Get the hat trick.
What's
Korean,
that?
right?
Korean. That is right. You were 3 for 3. I love it. Nom, give us a deal of the week.
Deal of the week. This week is, San Francisco has been the topic of the first few segments, so we might as well keep talking about San Francisco. This deal of the week is a purchase bridge loan, which we're seeing so many of out of the city right now, where we have a couple. In this case, they weren't moving out of the city. They were staying in the San Francisco, but there was a property that they wanted to jump on, and again, they had not yet sold their departing residence. We call it departing residence, which means the property that they are currently living in and plan to sell. So this is more of a lateral move. They were moving out of a house that was worth 1.5 and moving into one that was 1.66, but they had so much equity in their departing residence that we were able to make them a loan pretty much right at around 100% of the purchase price. We made them a loan of about 1.656, 4,000 less than what the purchase price was.
That's great.
Yeah, and so we, it's, as we always talk about, it's one of our bridge loans where we're using the equity and their departing residence collateral. So it's cross collateralization on a property that they're also buying in San Francisco. They will pay us off as soon as they sell their departing residence, which on average is about 4 or 5 months. So, these loans are meant to be temporary. They're meant to solve that dilemma of, giving the buyer the opportunity to buy their next home before they sell their current home. And we have seen so many bridge loans coming in San Francisco and Marin over the last 6 weeks. It's got to be tied to some of the articles and what's going on that I mentioned earlier in the segment, which is the number of people the number of listings, the number of transactions that are happening over the last 6 weeks is huge. We haven't had this busy of a July in a long time, so that's great. It's been really busy. But in the last segment, Rob, you were talking about some of the rates and how low they can go. It's funny because I always get, hey, here's your most recent credit score through your credit card company will tell you. Here's your credit score from whatever agency that they use. And then my bank will do the same thing. Here's your monthly statement and here's your credit score or your FICO score. As somebody who, when I buy my home and I'm seeing these great rates or I'm looking to refinance, is there a way to equate the credit score with the interest rate that I could potentially get? Or is that too generic or general of an assumption to make? And also, which score is the most accurate?
Good question. So we deal with the FICO model, and there are some different models. There's the Vantage scoring model, and when people go on to Credit Karma and things like that, they see things that are different than we pull. We pull a residential mortgage credit report. It's a tri-merge, and it brings in the FICO score for Equifax, Experian, and TransUnion, all three. And we'll typically use the middle score for each borrower, and the lower of the two middles will, if there's a married couple, for example, or a couple on the application, we'll use the lower of the two middle scores. But consumers need to be aware that the scores that they see from consumer services are often a lot higher than they are for a mortgage. And the reason for that is when you make a mortgage or a commercial loan inquiry, the credit agencies know that's where it's coming from, and those industries sort of weight that average because they realize that the consumer may be getting a loan that is going to be the single biggest piece of credit that they have. So I've seen, for example, consumers have sent me screenshots of their Credit Karma coming in at 780, and then when we pull their credit score for the mortgage, it's 745. So not uncommon to see that it's a little more conservative. But in general, for a conforming mortgage, if your score is over 760, that's as high as you need. There's no further benefit once it's over 760. And once it's over 740, in many cases with a conservative loan to value, again, you're in the best pricing tier. For jumbo loans, you sometimes see pickups for over 780 and over 800. But it's pretty rare to see that on a mortgage pool. I mean, it takes a lot of, everything to be right. And once you're in the mortgage arena for a loan, keep in mind that lenders also are looking at the amount of trade lines you have. So those are the individual accounts that are reporting on your credit score. So it's not only just having a good FICO score. Jumbo lenders also want to know that you've managed credit and have credit depth over your credit life. So it's a great question. We get a lot of questions about the FICO scores. Those are good questions for us that we're happy to help answer them too. But that's, to your point, 740, 760 on a mortgage is considered really good.
Cool. You guys ready for a fun joke?
Sure.
Is it joke time? It's joke time. Okay. A fleeing Taliban terrorist, desperate for water, was plodding through the desert when he saw something far off in the distance. Hoping to find water, he hurried toward the image, only to find a very frail little old Jewish man standing at a small makeshift display rack selling ties. The Taliban terrorist asked, "Do you have water?" The Jewish man replied, "I have no water. Would you like to buy a tie? They're only $5. The Taliban shouted hysterically, "Idiot infidel! I do not need such an overpriced Western adornment. I spit on your ties. I need water." "Sorry, I have none. Just ties. Pure silk and only $5. "A curse on your ties. I should wrap one around your neck and choke the life out of you, but I must conserve my energy and find water." "Okay," said the little old Jewish man. "It does not matter that you hate me, threaten my life, and call me infidel. I will show you that I am bigger than any of that. If you continue over that hill to the east for about 2 miles, you will find a restaurant. It has the finest food and all the ice-cold water you need. Go in peace." Cursing him again, the desperate Taliban staggered away over the hill. Several hours later, he crawled back, almost dead, and said, "They won't let me in without a tie."
Oh, no.
I love that one.
Hey, did your family laugh at that joke, Edward?
Yeah, they call them dad jokes,
Yeah.
Yeah, exactly.
I'm sorry, I saw that one and I go, I got to just bring that up on the show because, we have thoughts of the day and, deal of the week, and now we joke of the day, that sort of fun stuff.
It's a good break out away from talking about
I know,
real
especially with all the
estate
craziness
loans,
going
right?
on. So, Nam, just really quickly about the fund. Been around since 2013, never missed a distribution, never had a loss.
Mm-hmm.
Average loan to value 60%.
It's about 60%. The average duration of a loan, which is a question people often ask, is, do you make a lot of 30-year loans that are in there? So what happens if the market changes and you're stuck with a portfolio of loans that you can't get out of, meaning that they're not going to refinance anytime soon? Well, short answer is no. We don't make a lot of 30-year loans that we put in the fund. We do have a 30-year private money product, but our average loan in the fund is probably around 18 months or so, and it's a mix. Very short in duration. The bridge loans in particular, typically they're written for 11 months, but they often pay off in 4 or 5 months.
All right. Check them out. We got to cut to our last break. Check them out at pacificprivatemoney.com. Stay with us. The Best of Investing will be right back with some closing comments. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Nam Phan and Rob Spinoza. No trivia question, but one thing I wanted to make a point of that, some people are always kind of really leery about investments, and the question came up one time, with Pacific Private Money, how do we know you're not Bernie Madoff, and all that kind of stuff. And the interesting thing is, people can go on to a title company and check the records and see that, you actually do have recorded deeds of trust. It's
not in your name, Edward.
What's that?
It's not in your name.
It's not my name. Yeah, exactly. Yeah, it's trust and verify. Check them out again at pacificprivatemoney.com. All those great stuff's on the website. Rob, you had an interesting stat you want to share with us about homeowners?
Yeah, it's always funny when we're all in finance and we're all in real estate, but I always find it funny. I think like across the country that 1/3 of homeowners are free and clear. And I just read that 1 in 5 California homeowners live mortgage free, and only 5 states had fewer living without a loan. So pretty amazing that, it's like at the end of the rainbow, right? A lot of people, they invest in property, they get a mortgage, they take advantage of lower rates and whatever. And what's the end goal on a lot of this is people that ultimately reach maybe retirement free and clear. And, it's a good reminder that a lot of people, through making the smart moves and dealing with people that they research and stuff like that, do end up accomplishing that. So I think that number always startles people, that many people are free and clear.
That's interesting because of the average price point for homes in California compared to the rest of the country. It is also,
but it's like that saying, the best time to plant a tree is 20 years ago, right? So it's like a lot of these people bought these properties when, the market was down in San Francisco or whatever. They took advantage of these opportunities and they got in, and then they got the loan paid off. And now those are income producing in some cases, or, a roof over their head without a high cost of living associated with it. So, people tuning into the show need to remember that is, it's a lot of why people do this. This is to end up owning a real asset with real value and no payment associated with it.
Yeah. It's interesting. You mentioned that about being the free and clear, because Pacific Private Money is going to be coming out with a new fund within a month that's basically going to key in on those free and clear homes, because some people sell those homes and the borrowers who buy those houses, they can't get a conventional loan, and so the owner ends up seller carryback, as they say, acting like the bank. And so Pacific Private Money is going to be taking advantage of those situations and most likely providing a very nice compounding return for that.
Stay tuned for that.
Yep. Yeah. Stay tuned. Stay tuned for that. We'll also have probably a couple of guests, and the distributed anticipated rate is going to be probably close to 9%. We're trying to get that. I'm going to help Pacific Private Money kind of put something together on that, and we'll be searching for some of those loans, which we already have in the portfolio, kind of getting set up again, probably along the same lines of no fee to get in, no fee to get out. Not sure about the whole time. Could be just as little as a year, but that'll be probably a 9% distributed rate. All right, we got about 30 seconds before we have to give our thoughts for the day. Rob, why don't you give out your information one more time? People want to get a hold of you because you're a very good mortgage broker.
Thank you, sir. Rob Spinoza, Guaranteed Rate, 415-367-5959. And we have a great website, helpful information, easy to access, www.rate.com for RATE interest rate.
And Nam, why don't you give out your information if people are interested in the Pacific Private Money Fund?
Yep. Call us at 415-883-2150, or you can reach us at www.pacificprivatemoney.com and go to the invest page, because we go into some detail about the Pacific Private Money Fund, as well as some of the other funds that we offer, other ways to invest.
And if you don't qualify, you can always go to privatemoneyloans.com and register for free there. All right, guys, here's our thoughts for the day. When you clean out a vacuum cleaner, you become the vacuum cleaner, right?
Yeah.
And the quickest way to double your money is to fold it in half and put it back in your pocket.
Well, put it back in your pocket.
All right, tune in to the best of investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.